Good afternoon and welcome to BizTech's ASEAN Midday Market Watch. Our guest today is market strategist Stephen Innes. He's the Chief Global Market Strategist at Axie. Steve, great to have you on the show.
Thanks for having me, Brian. Good to be back on.
Now, Steve, before we speak to you and get your insight, I want to take a quick look at markets around the region. And we're going to start with the SGX, which is at 2,980.83. It's up 0.26%. Bursa Malaysia is at 1,573.38. It's also up 0.4%. Now, if we look across the region in Asian markets, we will start with the Nikkei, which is down 0.73% at 29,466.23. The Shanghai Composite is down 1.07% at 3,513.53. The Hang Seng is down again also 0.84% at 29,204.77. The ASX 200 is down 0.24% at 6,773. But the Kospi is in the green. It's up 0.85% at 3,038.46. Now, what's your view on how markets have reacted to the gains overnight on Wall Street yesterday, Steve?
It's a little bit confusing because there's a lot of noise going on in the rates markets right now. And there's some thought here that we could be seeing some divergence in central bank policies. For instance, the PBOC earlier came out today and expressed some concerns that asset bubbles are growing overseas and they're worried about domestic property sector. This is implying that policy is going to be not so accommodative going forward. This isn't good for Chinese equities, and we're seeing their reaction accordingly. Whereas we're looking at Korea. Although not everything is flying, the idea here, however, is that the export sectors are going to continue to remain flourishing, and this is good for a lot of Korean exporters, and this is why Korea is doing well. I think it's going to really come down to almost a differentiation between central bank narratives again. I think, we can look at the RBA, for instance, they continue to beat the dovish drum. I think we look at the Federal Reserve Board, they can continue to beat the dovish drum, but they don't even seem concerned about the yields rising. And this is a real positive thing because what's happening right now, and could be misinterpreted, and I could be completely wrong also, mind you, but I think yields are definitely rising because growth is rising, economic conditions are improving. Look, we had that big beatdown in the bond market last week, but what was really missed was that economic data is ripping higher across the globe. Sure, there's some pockets of weakness, but in general, economic data surprises are doing wonders. And to me, this is the reason why bond markets are normalizing. They're normalizing on a better growth impulse.
And this synchronized global growth is then supporting optimism from the vaccine side as well.
J&J vaccine is well, I won't see it's a game changer, but I mean, it's just adding to the fervor because now there's 3 vaccines rolling out in the U.S. and that just brings you closer. The U.S. market's closer to herd immunity. Mind you, we're miles off herd immunity. Don't even think we're going to turn that corner anytime soon. But there is a flattening of the curve to some strong degree. But look, COVID's still in charge here. Let's not forget the underlying narrative. We haven't beat COVID yet. COVID is still a problem throughout the world, and it's going to continue to be a problem until we can vaccinate the world. And that's where the problems lie, is getting the vaccines into everybody. Not just developed markets, but emerging markets that are continuing to struggle under the issues with the COVID beatdown.
Now, what's your view then on oil prices as we look ahead to the OPEC Plus meetings on Thursday? Now, given on one hand, producers like Russia are pushing for the tapering of planned production cuts, but on the other hand, the Saudis are a lot more cautious.
I just think the market has to sort of normalize on an equilibrium here, where more supply has to come back to market to offset higher prices. It's just a natural function of how oil markets operate. Look, we need oil to be in a more neutral range. We can't have oil continue to, on a monotonic rise every single day we come in, or on a month-to-month basis. It has to plateau. The reason why it has to plateau is because it's a significant input in the global growth narrative. It greases the engines. I mean, higher oil prices are negative for big countries like India and other importers of oil. So we have to keep that in mind, that once we're emerging, we have to have some semblance of normalcy. But I do believe oil prices are going to continue to rise. Even the fact that we're going to see a normalization in supply. It's going to be a gradual normalization. And I think the deficits are still going to be held in inventory data, and this is going to continue to push oil higher. But we're going to see more supply being put back in gradually. So it's going to be a balancing act. Where that balancing act hits, I don't think oil is going to make much headway above the 65-70 Brent level in 2021. And that's simply a function of excess spare capacity not being used, and which will be coming back to the markets as prices start to move higher again.
Now, Steve, I want to zoom in on an oil producer that is benefiting from oil prices being above its own market projections. Now, that's Malaysia. Now, what's your view on Malaysian equity markets and the ringgit, given the recent poor purchasing managers index numbers, and then in contrast to that, the stable US dollar and higher US Treasury yields?
Yeah, the PMI data underscored the struggles that Malaysia is having emerging from the COVID beatdown. That's just a fact of life, and that's, to me, holding back the ringgit. One of the views that I had a couple of weeks ago is that, geez, we've really priced in a lot of this vaccine optimism. Sure, we've had another J&J, but a lot of that's priced in already. We're priced in a lot of this U.S. stimulus, so it's really up to the economic data to do the heavy lifting. None more so the case than in Malaysia. I think the government has now received a little bit more policy wiggle room because of higher oil prices, because that actually balances out the government coffers. Remember, the government was projecting oil prices below $50 for 2021. This is a real windfall when you get more petrodollars per barrel, and that will directly, and that could actually be put back into the economy again through some form of fiscal stimulus. So they'd still have that. B&M still has they're keeping their powder dry on a when-need basis. Markets pulled back from the accommodation stance that they had thought perhaps B&M would bring in one more interest rate cut. That's not happening. So really what's happening, I don't believe that's going to happen. It's not that it's not going to happen. I don't believe that's going to happen because they're going to wait for the reopen narrative, the vaccine narrative to take hold. All these positives should make the economy lift off on its own volition rather than the need for dropping interest rates. Overall, my longer term view on the ringgit is quite positive because I think commodity prices are going to continue to remain stable to higher. I think China optimism is, despite the PBOC pulling back a little bit on stimulus, I think it's still going to be a strong economy. Malaysia exports a lot into the Chinese economy, but when the developed markets pick up, Malaysia will be exporting a lot into the developed markets, Western world, and that's going to be good for the ringgit.
Good. It's good to hear positive notes on the Malaysian economy and the ringgit. Now, what events and data points should we be looking out for the rest of the week that will move markets?
Well, we're going to have Fed speak, and I think people are going to be paying attention to every Fed member that talks. Last night, Lael Brainerd was out beating the Dove drum, and that's pretty much what we expect, because this will be the last week before we move into the blackout period before the FOMC meeting in later this month. The other factor we're looking at is the granddaddy of them all data, which is the non-farm payroll that's coming out on Friday. That'll probably catalyze a lot of views that are happening in the markets right now, whether the market's picking up. Remember, employment has been a real center focus of the Fed and the Treasury, U.S. Treasury, Janet Yellen's mandate. Employment starts to pick up, it's going to feed those inflationary fuels again, and we'll probably see bond yields rise. How bond yields rise in reaction to improving growth is key in this narrative right now. I think there's a willingness now that the market may allow or not really get too beaten up by bond yields rising after we've had that mini taper tantrum, realizing that it's a function of growth, not necessarily a function of the Fed pushing back against policy inputs.
Now, Steve, thank you very much for taking the time to come on the show again.
Thanks for having me, Brian. We'll talk next week.
Now, we've been speaking to Stephen Innes, Chief Global Market Strategist at Axie, on BizTech's ASEAN Midday Market Watch. I'm Brian Fernandez. Check out www.biztech.asia for business and technology conversations.